Precious metals, seasonality wise, usually actually come into favor right at the end of July. So August to early October, we tend to see gold move up. Not saying that's going to happen. In fact, I actually feel like it's going to do the opposite, but we are definitely in summer doldrums. And so gold really over the past couple of weeks, really just, it started to slope down. There's no doubt gold is in a new bear market. It's down 26%. Percentage wise, anything above a 20% decline usually kicks you into a basic technical bear market. But the price is actually showing in moving average that we're in a bear market. And so it is telling us we're going to see about 11% haircut in gold to about $3,600 per ounce. That's the next wave. After that, we can recalibrate and find out where the next wave is, which is, it could actually be even lower, around 3,300. So gold is holding on. It is clinging on. People have got a lot of hope and that it's going to turn around and start to rally. But overall, it's in a bear market. The odds are this is just a pause before it goes lower.
Precious metals usually enter a favorable seasonal window from August to early October, but current chart patterns indicate this historical rally may completely fail. The market remains deeply mired in summer doldrums as technical structures continue breaking down across the board. Chris Vermeulen, a well-known technical analyst, chartist, and founder of the Technical Traders, emphasizes that gold is firmly locked in a new technical bear market after suffering a sharp 26% decline. With the key 150-day moving average sloping downward, the psychological $4,000 support level offers only temporary relief for hopeful buyers. Recent chart data published on Kitco News Analysis shows that Fibonacci extension theory predicts a definitive 11% haircut targeting $3,600 per ounce. Following that initial wave, price recalibration predicts an even lower decline toward $3,300 per ounce before a genuine market bottom forms. Relying on hope for an immediate turnaround ignores clear mathematical tools pointing toward extended price weakness. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Precious metals, seasonality wise, usually actually come into favor right at the end of July. So August to early October, we tend to see gold move up. Not saying that's going to happen. In fact, I actually feel like it's going to do the opposite. But we are definitely in summer doldrums. We saw the euphoric rally in precious metals late last year, early this year. It has come to an abrupt stop. And the reality is, from a very basic high level, which is actually very powerful, I like to look at the 150-day moving average. It tells you if it is sloping up and prices above it, you're in a bull market. If it is trading sideways or prices chopping through it, then you're in a neutral position. If the 150-day is sloping down and prices below it, you're in a bear market. And so gold really over the past couple of weeks, really just, it started to slope down. There's no doubt gold is in a new bear market. It's down 26%. Percentage wise, anything, above a 20% decline usually kicks you into a basic technical bear market. But the price is actually showing in moving average that we're in a bear market. Now, there is a short-term support level here, Danny, at that 4,000 mark. And it's support for two reasons. First of all, it was a major support early or late last year. Naturally, price is going to find some support there, but it's 4,000, which is a whole number. If price is above it and it sells down to a whole number like 4,000, people are going to say, hey, I'm going to buy some. It's going to be a good deal at 4,000. And so that's where we're at right now. We are seeing just it act as natural support. We got buyers saying this is a good support level. This is the bottom, which I don't believe is true. And so that's where we are. Now, if we were to use technical analysis on here and use Fibonacci extension, it'll give us an idea of where gold is going to go. And the most recent sell-off, based on the strength of the bounce, this tells us where price should be headed for gold. And I use only two levels. I use the golden ratio, which is 618 extension, and the 100% measured move. And the theory is, and what I see happen over and over again, it doesn't matter what asset it is, if you come down and you hit the 618 level and you pause or bounce, you almost always go down to the 100% measured move. Now, Fibonacci theory is in everything in the universe. It is extremely powerful. It is, to me, is the number one most powerful tool to gauge where targets are and support levels are. And so it is telling us we're going to see about 11% haircut in gold to about $3,600 per ounce. That's the next wave. After that, we can recalibrate and find out where the next wave is, which is, it could actually be even lower, around 3,300. So gold is holding on. It is clinging on. People have got a lot of hope and that it's going to turn around and start to rally. But overall, it's in a bear market. The odds are this is just a pause before it goes lower. So that's the outlook for gold. From current price level, yeah, $40 silver is a 31% decline from where it is. There's a lot of downside potential. And then, of course, I think once it gets down there, I think it'll be a very significant opportunity to go, for the long-term game. So what I'm looking for in gold and silver as a long-term investor, getting rid of the active trading kind of active investing style, is I want to see gold hit 36 or 3,300. Depending how it gets there, that's when I'm going to start stacking physical metals again. Again, I closed out gold above 5,000. We closed out silver at 113. And so I want to look at buying gold long-term as a stacker at 3,600 and 3,300. For silver, I'm looking to pick it up around 40. That's where I'm most excited for the silver. And based on the charts, that's kind of the level that I don't have two targets for silver at this point. I just have that one. So I think that's when I'll start accumulating some physical for the next long-term super cycle in gold, because I believe it'll be fair valued, undervalued. And from there, I think it'll probably start to build a base. But I look at precious metals as an insurance plan. I kind of move in when I think they're oversold and it's a good insurance policy. I also exit when I believe they're way overvalued and you just need to benefit from it, which is lock in profits and reload at 50, 80% discount.
Silver faces a steep technical downside risk, pointing directly to a predicted 31% drop from current levels toward the $40 target. Following disciplined profit taking above $5,000 in gold and $113 in silver, the most prudent strategy requires staying patient in cash rather than pursuing active trading. Market tracking from Sprott Money Metals Overview confirms that reaching $40 in silver alongside $3,600 or $3,300 in gold will signal the ideal opportunity to resume physical metal stacking for the next long-term supercycle. Precious metals serve primarily as a wealth insurance policy, requiring strategic exits during overvalued euphoric rallies and aggressive reaccumulation at a massive 50 to 80% discount when assets become fair valued or deeply discounted. Rotating money safely protects capital across major market cycles, ensuring wealth survives broad market contractions. Now, let's get back to the interview.
We've seen the dollar put in a fairly significant bottom. So we've seen this big formation here, this rounding formation. We saw the 150-day sloping down, put us into a bear market phase. It's carved out a bottom over the last couple of years. It's now broken through resistance. We have a series of higher lows, series of higher highs, which is the definition of an uptrend. We have a nice bull flag forming. It is pointing to higher pricing. And, this is the thing. We've got the dollar in a new bull market. Higher dollar is going to put pressure on the metals space. So if the dollar's in a bull market, which it's showing and it is, and precious metals are actually already in a bear market and trending down, it's perfectly in line for these two assets. If anything, you should be long the dollar and you should be out of metals in the miner space until those trends change direction. And so when we look at the dollar, I believe we could see the dollar index eventually, it's going to, I think, have a series of bull flags. And it's going to start to rally up to 110, potentially even a whole lot higher. If we go way back in time and look at where the dollar has been, where we can go further back, but there's a lot of upside potential here. And when we look at that type of move from where we are right now, we're looking at an 8%, potentially 13%, and going way back in time, which I'm not sure if the daily chart will want to load back then, but we're looking at going up to 120 and change, which is let's just see where that goes up to. It's about a 20% upside move. So there's a lot of potential. And if the dollar is rallying, we're probably seeing global crisis take place. And we tend to see the dollar do very well during those stints. We've seen it happen over and over again. We saw back in during the tech bubble, we saw the US dollar rally 20%. 2007, 2008 financial crisis, it rallied about 25%. In 2022, we saw a big rally of 20 something percent. So when there's chaos and things are falling apart, the dollar tends to shine. And that is going to put a nail in the coffin for precious metals. It's going to continue to grind them down or hold them down, even if the fundamentals make perfectly good sense for metals, which there always is a good fundamental story for it. It doesn't mean they're going to go higher. They might just trade sideways and be dead money until the dollar puts in a top. At some point when the dollar, if it gets up here and puts in a top, Danny, it's going to be an epic short play, benefit from the collapse of the dollar that everybody's been talking about for decades, it feels like. And then also pile into precious metals and miners, because it is going to be an epic precious metals rally. I mean, look what happened over here. You remember getting into gold, silver, and miners back in early 2000s, that epic drop in the dollar and how big miners were moving thousands of percent. And I believe that setup is coming. It's just probably still a year or 3 away. But it is coming, and it will be a life-changing opportunity. The key is to not jump in early because you know it's coming. It's to wait for it to unfold and get in when there's blood in the streets and things are undervalued and the potential is there. So I love looking at the dollar. When we look at the dollar from a long-term standpoint, I mean, it's channeling to the upside. It goes sideways, it rallies. It goes sideways, it rallies. It goes sideways. And I think we're about to start a new rally. This little bottom that we saw recently is similar to this one. It's similar to a bottom that was put over here, or potentially this bottom. I mean, we're primed and ready for, I think, a chaotic world where things actually fall apart. We go through another financial crisis, and we're starting to see this in the 30-year yield, right? We're 27 days, the 30-year yield has been over 5%. And the last time it was like this high or higher, it was 2007, just before the financial crisis. So we saw 50 days in 2007 where the 30-year yield was over 5%. And then we saw everything blow up. This is telling us there is major global concerns. There's lots of worry. So there's a lot of things brewing under the hood. And if you don't have a game plan, when we do have a financial correction, because it is just a matter of time, if you don't have a game plan, say goodbye to retirement, say goodbye to the last 30, 40 years of hard work. It's going to vaporize if you're not in the right assets, or at least just step aside, right? Even this is the crazy part, stepping aside and just putting your money, sitting it still in the dollar, in just cash. You don't have to even invest it in the dollar index. Just hold US dollars in a savings account and earn 3 or 4 or 5%. You will do way better than losing 30 to 70% in all the other different assets that are going to crash, right? And holding that US dollar in cash, don't forget the dollar is going up in value. And so when all that happens, you could actually move to another currency down the road and flip that cash into a different currency like the Canadian dollar, which eventually I think will become a very good play. So it's all about just rotating. And that's what I focus on. I call it asset revesting. You rotate your money to which asset has the best opportunity, the lowest amount of risk, and we just rotate from one asset class to another. It could be stocks, it could be metals, it could be a currency, it could be cash sometimes, and it keeps it really, really simple and low stress, low risk. It's pretty boring, but it works exceptionally well for managing, big wealth. It's not about generating massive returns. It's about protecting what you've got no matter what happens, and just rotating through these big cycles that I'm showing you here from bull and bear markets. Just move your money to where the money is flowing.
A decisive bullish breakout in the US dollar index is signaling severe friction ahead for global financial markets. The dollar has carved out a multi-year rounding bottom with higher highs and higher lows, forming a bull flag that predicts an initial rally to 110 and an ultimate 20% upside move toward the 120 level. Historically, major dollar surges accompany global financial chaos. As seen during the 2000 tech bust, the 2008 financial crisis, and 2022. According to bond market data on Y-Chart's 30-year Treasury rate trends, the 30-year yield remaining above 5% for 27 consecutive days mirrors warning conditions last recorded right before the 2007 meltdown. In this chaotic environment, holding cash in US dollars yielding 3 to 5% easily outperforms, suffering 30 to 70% losses across crashing assets. Practicing asset revesting by protecting liquidity preserves capital today, perfectly positioning investors for an epic precious metals rally predicted to unfold 1 to 3 years away. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.